Sebi has now announced some major decisions after its board meeting yesterday. It was a broad market reset from mutual fund fee to stockbroker rules to how IPO shares are locked in and disclosed to investors as well. The regulator has slashed and unbundled the mutual fund expenses, overhauled 3 decades old stockbroker regulations, and pushed brokers to show every cost and compliant trail to clients as well. The IPO norms have also been aced with a tech-backed system to mark pledged pre-issue shares as locked in, making life easier for promoters while tightening the guardrails for public investors as well. A revamped investor charter for brokers now forces clearer rights, timelines, and a stronger grievance redressal system as well across scores and online dispute resolution. And for more on this, we want to just gauge one by one what exactly has happened and how will the end investor at large be impacted with all these newer norms that are coming in. Let's start off with the mutual funds, because a larger audience of India today have started to invest in mutual funds in a big way. We have seen the SIP flows all month on month increase to record high levels. So the focus is there. On the mutual fund, the expense ratio, that's the fee that we pay to AMCs to manage our money on an annual basis, has been changed, unbundled, reduced. The big question is, are mutual fund investments getting cheaper for investors like you and I?
Well, hi, good afternoon, Sakshi. Good to be on the show always. Well, very quickly, let's understand the intent of SEBI as a regulator. Well, so to begin with, the intent of the regulator has been very clear to make the markets more efficient, to make the processes more transparent, and to give the economies of scale, the benefit of economies of scale to the investor, to the end investor. As you rightly pointed out, that SIP numbers have been going up regularly, and we are at about 29,000 crores per month. That's the SIP numbers. The total asset under management has also gone beyond 80 lakh crores. So I think there was definitely a time that the benefit of economics of scale would be passed on to investors. Accordingly, as you rightly mentioned, there has been an unbundling of the charges. So let me just explain very briefly what was
Sure.
the situation earlier. So, if I as an investor was given a number, which was termed as total expense ratio. So this was a total expense that I would pay to the fund house as an investor for managing my money. Now, the fund house internally would break that internally in the fund management charges towards the brokerage fees, towards stamp duties, GST, all that put together was bundled and termed as total expense ratio. That is what an investor would be paying to the fund house. Now, what SEBI has done is they have unbundled it to that extent to say that there will be a base expense ratio. So this is going to be the fund management charge. All the statutory expenses are beyond that, such as the GST, such as the securities transaction tax,
Yes.
such as stamp duty, etc., will be in addition on actuals. So very clearly, the unbundling has happened, so that investor clearly knows what is going towards fund management charge and what is going towards the statutory expenses. Earlier, it was all combined together into one terminology, which is total expense ratio.
Okay, so help me understand, Mr. Harshvardhan, that when it comes to the average investor, how does one understand what is the kind of differential that they will have to probably enjoy now with this reduction coming in? Of course, unbundling is one thing, but you still have to pay taxes in some other fashion. But when it comes to the entire expense ratio, how much of the cost gets reduced for me if I invest via mutual funds? What is the aspect there?
Okay, so the first part, as I said, was just unbundling the total expense ratio into a base expense ratio plus the actual statutory expenses. Now, on the other hand, there have been certain reduction in the expense ratio by itself. For
Correct.
example, the mutual funds were entitled to charge a maximum expense ratio of say 1% for index funds. Now that has been reduced to 90 basis points. So that maximum that a fund house can charge you has also been rationalized downwards and reduced by about 10 basis points. So that's one cost that you will see that there would be a reduction. Though I may say that most of the fund houses were not touching the maximum limit in any case.
Okay.
That was the
All right.
maximum that you are entitled to charge. Does not mean that they were charging that much, but that maximum has also been reduced by about 10 basis points.
There
Now,
is a
there is
cap, so
another.
to speak, now. That 0.9%, you cannot charge more than that as a mutual fund company.
That's correct. So invariably, however, I just want to reiterate, however, most of the fund houses but not charging 0.9 in any case or 1% in any case. Just that that limit has now still been reduced. The maximum that you're entitled to charge has also come down, though invariably most of the index funds would be charging between 30 to 40 basis points. So, however, there is some
Correct.
rationalization over there happening as well. The other area, there was a temporary charge of 5 basis points that every scheme
Yes.
was entitled to charge if they were leaving exit loads. So now that has been completely done away with. So there's again a marginal cost saving that you will have. Now, within internal points that I would want to highlight, there is a cap on what the fund houses pay towards brokerage for transacting. So earlier there was if you had to buy and sell shares in the cash market, that's what mutual funds do, right? Eventually, there was a cap of 12 basis points. Now that
Right.
has been reduced to 6 basis points. If you're dealing in FNO, the futures and options market, then the cap was 5 basis points earlier, which has been reduced to 2 basis points now. So I think all these cost reduction measures that have been incorporated, some may be applicable immediately, some will take some time to pan out. Overall, the intent has been to reduce the cost of investing for investors
Yes.
so that
Yes.
the efficiencies could come in and investors experience higher returns, at least to that same context in which the expenses have come down.
I know. Mr. Harshvardhan Roongta, I wanted to understand, I know this will be a difficult question because we don't have a clear answer as to how much will each AMC charge now that the revised capping of the charges have come in. But for any average investor who does, say, a 10,000 rupee SIP, over the next 10 years, 20 years, 30 years odd or so, what is the kind of broad range of savings that they can do on these charges now?
Well, as you said, it's a bit difficult to
Yeah.
quantify the numbers, but I would say that you can expect a reduction in the cost to the extent of approximately 10%. So
Okay.
if you were paying a total expense over a period of time for say about a 1 lakh of rupees was your total expense that you were paying, that you could expect it to come down by 10% to 90,000 now.
Fair
And,
point.
I think anyone would make a guess that after a couple of years again, when the market expands further, more investors come into picture, the benefits of economies of scale will be further passed on. So I think this is one of the measures in the right direction, clearly making sure that the investors stand to gain from reduced cost so that it directly commensurates into higher returns for them.